Let's talk about stablecoins, digital currencies designed to avoid the wild price swings of Bitcoin and other cryptocurrencies. Unlike Bitcoin, stablecoins are pegged to real-world assets like the US dollar or euro, aiming to keep their value steady. For every stablecoin issued, there's supposed to be a matching dollar or euro in reserve. This one-to-one peg is what gives stablecoins their name and their promise of stability. You can trade a stablecoin for a real dollar at any time, making it useful for those who want to avoid crypto volatility. Stablecoins bridge the speed and global reach of crypto with the reliability of traditional money. They're used for trading, earning interest in DeFi, and even as digital savings. Their popularity has soared, making them a cornerstone of the crypto ecosystem. But as stablecoins grow, they start to resemble and impact the traditional financial system. Central banks are taking notice, asking tough questions about what happens if the stable in stablecoin fails. The bigger stablecoins get, the more they matter to the entire economy. And if that stability ever cracks, the consequences could ripple far beyond the crypto world. That's why policymakers are watching stablecoins more closely than ever. The question now, are stablecoins truly as stable as they claim? Why are billions pouring into stablecoins? Because they solve a core problem in crypto volatility. In traditional finance, the dollar is the stable yardstick. In crypto, stablecoins fill that role. Traders use them to move in and out of positions quickly, avoiding the hassle of converting back to regular money. Stablecoins are the default currency of the crypto economy, offering speed and efficiency 24/7. They're also the backbone of DeFi, letting people earn high interest or use them as collateral for loans, no bank required. For people in countries with unstable currencies, stablecoins offer a way to protect savings from inflation. They provide access to a global financial system that might otherwise be out of reach. This mix of utility, opportunity, and protection has fueled explosive demand. But as stablecoins grow, so do the risks. Their popularity is a double-edged sword, bringing both innovation and new vulnerabilities. The question is, can stablecoins handle the pressure as they become more central to global finance? Or are we building on shaky ground? How do stablecoins stay stable? The answer: reserves. Issuers promise to hold real-world assets, like cash or government debt, for every coin in circulation. But the reality is often murkier. Reserves can include riskier assets like commercial paper, not just cash. If those assets lose value, the stablecoin's peg can break. Confidence is everything. If people doubt the reserves, panic can spread fast. We've seen this before. The collapse of Tether USD in 2022, an algorithmic stablecoin, wiped out billions when its system failed. The lesson? Stability is a promise, not a guarantee. Any crack in trust can trigger a crisis. Central banks are wary, knowing that a failure could have consequences far beyond crypto. The system relies on transparency and solid backing, but not all stablecoins deliver. As the market grows, the risks of a house of cards moment only increase. The question, are the foundations strong enough to withstand a real test? Or is a shock inevitable? The European Central Bank is sounding the alarm. Stablecoins have grown from a niche experiment to a market worth hundreds of billions, now deeply connected to traditional finance. Issuers hold reserves in commercial banks and buy assets like government and corporate debt. If a major stablecoin faces a crisis, it could trigger a fire sale, dumping billions in assets and disrupting crucial funding markets. The fallout wouldn't stay in crypto. It could freeze credit and ripple through the entire economy. The ECB warns that stablecoins are becoming systemically relevant, too big to fail without risking economic chaos. Central banks can't ignore this risk. The line between digital and traditional finance is blurring fast. The ECB's message: stablecoins are now a potential threat to financial stability. The time for curiosity is over. The era of oversight has begun. The question is no longer if, but when, regulators will step in. Olaf Slypen of the ECB isn't mincing words. Stablecoins are on track to become systemically important. The risk isn't just to crypto investors, it's to the entire financial system. If a stablecoin collapses, the shock could spread to the markets the ECB is sworn to protect. Much of this activity happens outside traditional regulation, making it harder to control. The ECB is signaling that the grace period is over. Stablecoins must be managed like any other source of systemic risk. If a run on a major stablecoin hits, the ECB may have to intervene, adjusting policy, providing liquidity, or taking emergency action. The message: regulation is coming, and central banks are ready to act if needed. The crypto world is no longer a playground, it's part of the global financial system. The stakes are higher than ever. The warning is clear: grow responsibly or face the consequences. What does a run on a stablecoin look like? It's a digital age bank run, fast, ruthless, and global. A rumor or loss of confidence sparks panic. People rush to redeem their coins for dollars, pushing the price below its peg. As the price slips, more holders panic and sell, creating a vicious cycle. The issuer must sell reserve assets to meet redemptions, but dumping billions in assets can crash those markets. The reserves shrink, the peg breaks further, and the panic intensifies. This is exactly what happened with Tether USD. Once the spiral started, it couldn't be stopped. Billions vanished in hours. For central banks, this is the nightmare. A stablecoin run triggering a full-blown financial crisis at internet speed. The lesson? Stability is fragile, and digital money can unravel faster than ever before. The risk isn't just theoretical, it's already happened. The next time, the fallout could be even bigger. Are we ready for a digital bank run on a global scale? Or is it just a matter of time? The fear of a run is as old as finance itself. History is full of crises sparked by a loss of confidence in safe assets. In 2008, money market funds, seen as cash equivalents, broke the buck after Lehman Brothers collapsed, triggering a massive panic. The US government had to step in to stop the run and stabilize the markets. The parallels to stablecoins are striking. Both promise stability, both rely on risky short-term debt, and both can unravel if trust disappears. Go back further and you find the same story in the bank runs of the Great Depression. Any financial instrument that claims to be as good as cash, but lacks a government guarantee, is vulnerable to panic. Stablecoins are just the latest chapter in this long history. The lesson: without ironclad backing and oversight, stable money can become dangerously unstable. Central banks know this, and they're determined not to repeat the mistakes of the past. The warning signs are clear. The question is whether we'll act before history repeats itself, or wait for another crisis to force our hand. So, what can the ECB do? First, push for tough regulation, forcing stablecoin issuers to hold only the safest, most liquid assets and undergo regular audits. Transparency and capital buffers would be mandatory, making runs less likely. If prevention fails, the ECB can act as lender of last resort, providing emergency liquidity or buying assets to stabilize markets. In a severe crisis, it could even cut interest rates to support the economy. The goal? Prevent a stablecoin collapse from triggering a wider financial meltdown. The ECB's warning is clear: regulation is coming and emergency plans are ready. The hope is that strong rules will make drastic action unnecessary. But if a crisis hits, the ECB won't hesitate to step in. The message to the market: stability is not optional. The era of unregulated digital money is ending. The future of stablecoins will be shaped by oversight, not just innovation. What does all this mean for you? If you use stablecoins, do your homework. Not all stablecoins are equal. Check who issues them and what backs them. Look for transparency, regular audits, and clear reserve reports. Diversify your holdings. Don't put all your digital eggs in one basket. Understand the difference between asset-backed and algorithmic stablecoins. One is generally safer. For banks, the ECB's message is clear: manage your risk and limit exposure to crypto. Central banks are exploring their own digital currencies, like a digital euro, to offer a safer alternative. The stablecoin market is maturing, and regulation is inevitable. For individuals, stay informed and cautious. For the financial system, it's time to build guardrails before the next crisis hits.